Hi, this is JR. This video is concerning how you can improve your finances in regard to your investments and the overall long-term profitability of your investments, as well as the uh, safety of your investments in the sense of knowing how much risk um, corresponds with the investments you're making so that you can decrease risk whenever you'd like, or um, maintain a low level of risk at all times. That raises the questions of why someone might increase their risk. And the classic answer to that is age. So somebody who's 25 years old might have a lot higher risk tolerance than someone who's 45 or someone who's 75. As people get older, typically they are interested in reducing their risk. So today I'd like to look at with you some charts, some price charts. And these are going to be pretty simple. These are the last 3 months of a few major markets. I'll identify the markets after I talk about the charts a little bit, because one of the things that might be a distraction for people is to know the markets we're looking at. You may recognize some of these charts, probably won't if most of the people who I expect to watch this aren't going to know what the price charts of different markets look like for the last few months. But if you don't consider what your current investments are for a moment, just for the purposes of coming to clarity about what's going on in markets right now, if you just look at the price charts without knowing what's in which chart, that can make it pretty simple to see some basic patterns amongst some different charts, so some different markets. I can't identify which markets we'll be talking about. I'll say the US dollar currency and its foreign exchange rate, or the US dollar index, is one of them, or it's represented in one of the charts. It's four price charts. So there's the US dollar, US stock market, US Treasury market or bonds for the US government, as well as I picked silver, so a precious metal, the price of that metal for the last 3 months. So those are the four charts of prices. And then I'm also going to talk about volatility, and there's a chart that shows precise changes in the measured volatility of a particular market. If you're not familiar with the term volatility, that means how erratic is the price movement in that market within a particular period of time, such as a day. Now, you can see volatility changing throughout the course of a day. There's ways to monitor that. It's quite simple. So it's not just the volatility as of the end of the day for the entire day. It's also volatility within the day. At any given moment within the market, how volatile is it? So that's a kind of an interesting piece of data to include as we're looking at price charts. And of course, we can see sudden changes in a particular day of a particular market. We can see a big move after the fact. It's very easy. We can also see trends where there's several days of an overall decline or several days of an overall rise. We're not going to be talking about sentiment measures, but that's something I often talk about, and it's also something that helps me to identify which markets I want to focus on in terms of where I consider there to be the least risk or the most risk. Sentiment charts are a very good way to make an assessment of a certain kind of risk. Price charts are not. Just to look at the price charts of anything, you don't know if a particular trend is going to last 3 months, 3 years, 3 days, 3 hours. Those kinds of projections are often wrong. So you can't just say, well, it's been 3 weeks, it's time for a change of trend. No. but you can look at sentiment data and get hints, you could say. You can get, data that indicates price when there's a risk of a certain kind of price reversal, an extreme long-term reversal in prices and trends. Volatility, though, is another measure. When we look at the charts of volatility, it's another measure that can allow us to be very clear about exactly what's going on for investors trading in that market. How are they behaving that day? Is there anything unusual about that day or a month or a week or whatever period of time we look at? So we're going to be looking at charts that are for the last 3 months. Today is December 18th, 2014. So we'll be looking at daily charts for the last 3 months. So that's about 60 trading days of data. So I'm going to put up an image. You can click the image as well so get a closer view of it. But we'll first look at some charts with no markings. I give some markings that are going to be hints for us in just a moment. First, you see those 4 charts. You can see at the bottom of each of those charts it says OCT, NOV. There's a line. Points goes down to OCT, then down to NOV, down to DEC. Of course, those stand for the months of the year, the beginning of a new month. Near the beginning of October, you can see that the 2 charts on the top were moving in the same direction, and then the 2 charts on the bottom were moving in the same direction, but the top 2 and the bottom 2 were moving in different directions. So the top 2 are moving down, the bottom 2 are moving up. Then, within the first few days of October, the bottom 2 have the same trend, or they reverse trend and join up with the trend of the top 2, which are still moving down. So you've got all 4 moving down together through middle of October. Then all 4 rise as of the middle of October. The rises are quite different in the different cases. In the top market, you see a rise that starts relatively sharp and just curves right off in a parabolic or just a kind of a pretty smooth curve, where as it gets higher and higher towards the middle of November, very little price movement at all for several days, and then it pops up again in late November, and then of course in the last couple weeks of December, the last few weeks as of right now, prices have moved down very sharply in that top market. Now if you look down to the market just below that, the second one down the screen, you can see it reversed early in November was the peak. Late in October and early November it went up to just over 31. The number over to the right of the chart, you can see the 31. So it went up just over 31 briefly at the end of October and beginning of November, 2 different days, and then headed down. And since early December, it's headed down pretty steadily in what we could call a trend channel. I'm not going to really talk about what I might mean by that, but you can see it's a pretty steady, straight sloping decline there. The market below that is probably the most erratic of the 4, especially since early November. You can see it's done some somewhat unusual things relative to the other markets. So from middle of October to early November, all of them rose, and then the second and third one made their peaks there in the first few days of November and headed down from there in general. And again, that third one down has some pretty erratic movement a couple times. That's the most volatile and lowest volume of the 4 markets that are shown on there. The bottom market it dropped in the last several days with a peak in early December. So the top one and the bottom one of those four, they rose not only from mid-October into November, but all the way into early December. The final peak for the top market was a few days into December, and the same for the bottom one. So I wanted you to be able to see all that without me overlaying all the alignments and everything, but now that I've said all of that, let's look at the same charts now with some color added, some vertical lines. The first one to the left is just in early October in green. That's when all four markets started to move together. So the bottom two made a peak, and you can also see that the top one and the second one, they also rose up for a couple days. So they actually, you could say that those two that were going down, they actually joined trends with the two below that were moving up. And everything moved up for a few days, and then all four of them moved up for a few days, and then all four of them moved down until mid-October in pink. So the early December time in blue is where the two middle ones peaked and then began to fall, while the top and the bottom ones continued higher throughout November, and they peaked in early December. I circled in orange those times. Now I do want to make reference finally to the fifth chart at the very bottom. That's a chart of volatility. You can see that the highest level of volatility was middle of October. There was also a low point in volatility in early December. And both of those highs and low, that high and that low, were both dates of reversals in several of these markets. The pink time in the middle of October, all four markets reversed. The orange in early December, only two reversed. And that volatility is actually volatility for the U.S. stock market, 500 stocks of the U.S. stock market. So it doesn't represent volatility for all four of those markets. It only represents volatility for, in fact, the very top market, the one at the top of the screen, the first one. But as you can see from those first four charts, clearly there are consistencies in terms of how investors are behaving across all four of these markets that are shown here. There are certainly differences, but there are consistencies. So one of the points I've been looking for stocks to, the top one is stocks. I've been looking for stocks to reverse for a while. I've also been looking for the US dollar index, which is the fourth one, or the bottom one of the four. Been looking for those to make their peaks and head lower, and they have apparently done that. And the rise of volatility is a pretty sharp rise in volatility is another sign that that may be a long-term trend change. And there's lots of data we could look at to identify, do we have a long-term trend change in place, or a multi-month or multi-week reversal, etc. Because of the consistency as of middle of October and the rise there, I have been watching markets throughout this time, and I noticed the peak in early November of the two middle markets. The second one down is the Treasury market yield. I think that's 30-year Treasury notes for U.S. government. And the third one down is it's related to silver prices. It's actually if you looked at actual silver prices, the chart that's the third one down would be basically that same chart flipped upside down. But it does represent silver prices, and you can see where the trend in silver is, moving. It's making its reversals in mid-November, and actually in early November in the green, and mid-November in the pink with all three of the others, and then in early November it makes a reversal along with the U.S. Treasury market. And silver, of course, is a global market. It's not just purchased in the United States. People in Europe, Asia, etc., throughout the world purchase silver. And of course, people throughout the world can be involved in some of these other markets, but silver is, we would say, is the most international or global of these four markets shown here, which is part of why it looks a little different than the others. But you can see that they all, all four of these charts move together in certain ways. So the second and the third one, which is Treasury bonds and silver, they peaked in early November. And once they did that, I became interested in when will the top and bottom one reverse? Or will they? I anticipated that they would. I know in the case of the bottom chart of the US dollar index, the sentiment data was one of the factors that suggested, even back in early November, that a reversal was near. And you can see that while throughout November that market did go up and down a little, it didn't go up much at all. And finally in early December, that bottom of the four, that one moved up to the orange high a few days into December, which was the same day as the high in the top chart of stocks. So because the middle two at the point in blue in early November had reversed, I was anticipating an eventual downward turn of the top and bottom chart. It's also possible that the middle two would have gone upwards. In fact, the third one down certainly had a big move upwards, but at the end of November. But because of sentiment data and other factors, but certainly sentiment data for silver markets, I anticipated a particular direction, a particular outcome as far as would these four markets all move down together, all move up together, or what? So I believe they're all moving down together, with the notable exception of the third one down, silver. It's actually gone up in the last several days. So one of the most interesting things for me is the issue of silver. Currently, in that third chart down, it says 120. That's where the current price level is. That is for a fund called ZSL, which is the top left of that third rectangle, ZSL. It currently is priced at 120, but it was 100 just a few days ago. I would expect that one to go back down toward 100 and below, and maybe tomorrow, maybe very quickly. It doesn't mean it will happen tomorrow or will happen in the next week or whatever. These are just my biases, and I am in position for markets to move in accord with what I just stated, which is for silver prices to go down along, actually, sorry, for the prices of ZSL, that third thing down, to go down. That would actually correspond to silver prices going up, incidentally. So what I want to bring attention to is that these markets move together. Which ones move together? Depends. So in that early section of October, all four of these moved together and then reversed all together, and all four moved up throughout October. And then two of them reversed in early November. And you can just see the synchronicity can shift between which two are moving together, or are three moving together and then one is moving differently, like in the case of that third one down in the last few days. It's gone up, while all three of the others have gone down on the whole across several days. So with sentiment, which isn't shown here, with volatility, which is shown at the bottom, and certainly with price movement of a variety of markets, we can start to notice what is the laggard. If four things that often move together stop moving together and one of them splits off and goes a different direction, I might presume that it's likely to resume, to come back in sync with the other three. But I would be curious about sentiment data. Maybe that one moves by itself and then the other three are going to join it. So I don't want to rely just on price data. I do want to use sentiment data in particular, and then I just put volatility data into this chart because I had already gathered it. You can actually trade volatility. So of the things in this chart, you know, the biggest price movements, the biggest numerical movements, volatility, the very bottom of the 5 charts, volatility is actually the thing that has the biggest biggest opportunity. You can purchase shares of a volatility index, and in October it went from 30 to 45, which would be a 50% increase in 5 days. A 50% increase in 5 days. In the early part of December, at that orange time, volatility, the VXX volatility index was close to 25. So let's just say 25 for, you know, simple math. So it was near 25, and that went up to 35 as of today, or very close to 35. So that would be an increase of 40% in maybe 8-9 days. So if timed carefully and if watched closely, a move of 50% in a few days or 40% in several days, those kinds of moves are available by trading the volatility index, in this case VXX. There's another one called VIX. So why am I presenting all this? I want people to have a sense of the simplicity of some of the analysis that I do, and also some of the unusual facets. If I know that the most interesting thing going on in markets is volatility, and volatility can spike up very quickly from, you know, 25 or 30 in that fund, it can pop up to 35, 40, 45, 80, 110. That kind of thing can happen, and if it does, it's often a very brief spike, as in the case in early October. So there's a variety of ways to trade these moves. I'm not going to talk about the actual strategies I use to benefit from these predictable moves and these synchronous moves. I say predictable more in regard to sentiment, because again, trends can change at any time. But for people who are focused in particular on one market, such as the U.S. stock market or the U.S. real estate market, the number one thing for them to do to improve their, to reduce their risk might be to diversify across several markets. However, notice that from early October to middle October, all 4 of these things moved in the same direction. So diversifying, in some cases, doesn't give you the benefits that you might expect from diversifying. So if everything moves together, diversifying makes little or no difference. But over the long term, we do see periods of time when there's a great amount of inconsistency between several markets, and then there are also periods of times when there is tremendous consistency, and those are predictable things as to when they will all move together and when they won't. I'm not going to talk about that detail right now, but people who think reducing risk is just a matter of diversifying, that is the beginner method of diversifying. If you really want to reduce risk, you've got to measure risk. You've got to not just, blindfold yourself and throw darts at a board or something with diversification, but really look at or hire somebody who's really looking at actual risk of specific markets. What does the sentiment data indicate? If you don't understand how sentiment data is predictive or what sentiment data is, I don't plan to address that in depth here, but it's a measure of risk. And what it measures in particular is the, well, you could say it measures complacency. That's actually a reasonable statement, but more specifically, it measures the extent to which there is consensus in regard to a particular market's future price activity. So if you talk to a bunch of people who are all interested in trading oil, for instance, and they give a really wide diversity of opinions. Many say they think oil prices will remain flat. Many say they think it's going to go up quite a bit. Some say it's going to go up a little. Some say it's going to go down a lot. Some say it's going to go down very hard. If you get this really lack of consensus, really wide range of opinion, then that is a certain kind of market condition. If almost everybody agrees that oil prices are going down, let's say, that means there's a lot of people who currently think it's going down who could change their mind. And when they change their mind, they could change their behavior, they change their activity, change their investing, change their purchases. So that is basically how how measurements of sentiment are. They're really measuring the extent of consensus and the type of consensus. Is there consensus in the direction of, is there a consensus that, is there a lot of room for people to increase their optimism about a market, or are investors extremely optimistic currently about a particular market, and there's a lot of room or a lot of people that could change their opinion and become more pessimistic or more conservative in regard to that market. So that's how sentiment data is actually predictive, where a price trend itself isn't predictive. You don't know if a price trend is going to last 1 year, 3 years, 3 decades. You know, there's no schedule for every 3 years prices reverse. That's not how it works. There are cycles, and there are periods, things like retail sales before the holidays for retail companies, but there are cycles like that, summer and winter, and vacation schedules. There's all sorts of winter storms, snowstorms, all those kind of things. There's a lot of different kinds of cycles that, of course, are real, but you don't have a really, they predict only what they predict. Cycles only predict what they predict. So some kind of cycle like a 42-month cycle or a 9-month cycle or something, those aren't really that useful in most cases by themselves. So we want to look at sentiment data, we want to look at price charts, we want to look at the congruence or divergence of different markets. Are they all moving together? Are they all moving totally differently? Or are a couple of them moving together and a couple of them moving opposite to that? Just to be aware of those kinds of issues. So again, as of right now, you've got the last few weeks of December, you've got 3 markets that are moving together, and silver is the one going in a different direction. So I anticipate that silver will resume movement with those other 3. And in my current positioning as of right this minute, markets are closed as I make this video. Stock markets and bond markets and so on, they're closed. I don't know that silver will necessarily join the others tomorrow, or will join the others to a particular extent, but I would anticipate that it would go back down to what on that third chart is the level shown at 100, that it would go back at least to that point. And certainly I'll be looking at the other 3 markets to see what they do, but I've already got a good sense of what the sentiment data show about the consensus of traders who are interested in various markets. How are they already positioned? What is possible in terms of a reverse of position, a reversal of their positioning? And because bonds, the second one down, have been going down since the middle of, or since early November consistently, I'm actually least interested in trading that one because it was the one that reversed early. So I'm watching it, but I'm not trading it. I'm trading silver most aggressively, and I'm also in positions right now. I don't think I'm in positions for the US dollar market. I tried to be in that order, didn't execute. But I'm in position for the US stock market to continue its decline that it's been going on more or less for a couple weeks. I would be in position for the US dollar index to continue going down. I think I am, but I have a very small position there. And as of right now, my position in silver isn't large really either, but it could be. Tomorrow I may, I'd be interested in it. In fact, during today's trading, I was very interested in that market. So that gives some insight into how I use sentiment data, how I use the various price charts to make general forecasts, to select particular markets to watch. This doesn't get into the specific positions that I would take, what I use futures, what I use options, and so forth, all of the complexity that can be involved with the actual trading strategy. But this gives you some sense of my forecasting analysis and how I will select particular markets and which direction I will select them to move. I do anticipate, well, I'll certainly be watching for volatility in the US stock market and other markets to increase. And if volatility spikes up really high, then I will be more interested in looking at sentiment data even more closely to assess, do I expect volatility to continue spiking, which I think is extremely, I don't want to say extremely possible, that sounds weird, but it's definitely possible that there could be a spike of volatility much higher than 35, much higher than 45, the level it reached in mid-October. It could be quite high. So I'll be watching for that, and I may, again, even be trading in the VXX index because it is a tradable fund. As a concluding note, if you have questions or want to share this with anybody, please do so. And I also help people to improve the privacy of their investments and their finances, help them to organize their finances, to set goals. I do some coaching, but a lot of what I do is simply executing trades for people, and I also do debt settlement services for people who have mostly credit card debts is what I've worked with, but it could be a medical debt. There's a variety of debts that could be something you'd like to pay off for much less than the actual dollar amount of the liability, the account balance. As another quick remark, I probably should have said this at the beginning, but in addition to things like, a fund that moves up 50% in 5 days or 40% in a few weeks, I've targeted smaller gains than that. So even if I'm aware of something like that in a market, I'm not actually targeting that big of a gain in that short of a time. What I did last summer or moving into fall was I was targeting 10 to 15, maybe 20% gains in a month, month after month. So that gives you an idea of what I'm actually, and I did produce that month after month. So, and for people who would like to see specifics about that, you can let me know. I'll send you a link to an interview I did with the client, and we go over the results that I produced. So that covers everything that I can think of to share at this time. Did I say So one thing that I didn't show here is other groups, and certainly there are many other groups. I could have looked at stocks worldwide as a group. I could have looked at stocks in the US versus stocks in Europe versus stocks, in a variety of other places, different regions of the earth or whatever it may be. I could have looked at different sectors of the US stock market. I am currently in position for XLF, which is a financial sector fund. And I could have looked at different treasury markets within the US, the 10-year bond, the 20-year bond, the 2-year bond, the 30-year bond. I could have looked at treasury markets in other parts of the world. So this is actually some of the 4 charts that I most often look at. When we look at silver, there's a reason I picked silver and not gold and not a bundle of precious metals or a bundle of commodities. I'm not going to get into why I selected silver today, other than that it was a market I've been watching, and it had something really unusual in the last few days, and that's why I'm actually trading for a specific kind of move in silver markets. So the US dollar index is a set, or it's created through a set of foreign exchange currency pairs. So I could look at the US dollar versus the Japanese yen, or the US dollar versus the euro, or the US dollar versus the Swiss franc, or any number of other currency pairs. One of the reasons I like looking at the US dollar index is it gives me a quick overview of everything put together, blended together at once. The S&P 500, the very top chart, it's actually 500 different companies. The stock prices of 500 different companies are represented in that index. So it's very unusual for me to look at individual companies in the US or anywhere else. I look at regional and national charts, and I look at sectors for, say, the United States. In particular, of course, I focus on the United States because I'm in the United States and most familiar with it. And if I was outside of the US, it's still a very active market worldwide. It's a big stock market. So I do look at sectors in the US occasionally. I almost never look at individual companies. Why? Because it's harder to predict. It's a lot easier to get data and trade trends across big bundles, across big groups. So it would be very reasonable for me to be interested in a group of precious metals or a bundle of commodities. It happens to be that I specifically selected silver because it's a little different than what you would see in other commodities. I'm looking at groups to see which group is most interesting. And then once I see the group that's most interesting, then I might pick what sector, what individual metal, what foreign exchange pair do I want to focus on the most. So that gives you a sense also of the multiple levels of analysis that can be any other time into looking for specifically good opportunities and specifically low risk trades. But in the case of silver, in the case of current market conditions, I identified silver as the most interesting, and then I picked a particular way to trade silver, which I will go ahead and say. I got some call options, so they're option contracts. They're a type of contracts called call options, and they expire in just a few days, this Friday, and this is Tuesday evening. So I'm trading a very specific way for silver to make a very large move very quickly, and that might not happen, but that's the current positioning I've taken, and may continue to take throughout the rest of the week, depending on how activity goes from here, depending on how markets move. And just as a reminder, markets are just accumulations of the activities of humans choosing to buy and sell. They place bids, they submit asking prices where they say, I'm willing to sell 10 ounces of silver for a certain price. Or it's the same as with real estate. I'm willing to sell these 3 properties for these prices, or I'm willing to buy these properties for these prices. So when the bids and the asking prices touch or cross, then a transaction happens. So all of these markets are measures of human behavior. That's what's shown here is trends of human behavior. These markets have no independent existence. These are just measurements about things that people worldwide and within the US chose to do in the last 3 months. Thanks for your attention, and again, if you have questions, feel free to send them to me privately or make a public comment, whichever your preference is.